back to the Capital Mindset Show. Today's going to be one of those videos discussing a whole sector. It's going to be the first one, and this one's going to be focused entirely on REITs, okay? So we're going to go over like the basics and then dive a little bit into the accounting. What are some things you got to look for in each different company? So hopefully this video provides value, and if it does, feel free to leave a like and share with other people if they're thinking about learning about REITs. So this will try to serve as kind of preliminary information as well as dive a little bit deeper again into some topics, okay? So the first things first is let's discuss what a REIT is. So REIT, R-E-I-T, stands for Real Estate Investment Trust, okay? Basically, all you need to know about that is it's a company that invests in real estate, okay? Done. That's what it is. All right, now I would love to discuss with you guys a little bit about the tax implications of REITs and some strategies, right? But you'd have to discuss this with your tax professional that knows your personal situation, but just an overview of the understanding. What are some of the benefits of a REIT, okay? So here I shared with you guys a good infographic by Million Acres, right? And so, because I want to cite them because they were the ones who came up with this, and it gives a good overview. So basically, dividends are taxable at your ordinary income rate, and there's a reason for that. The reason being it's a pass-through entity. Okay, pass-through entity simply means that this thing will not pay any taxes. The business will not pay any taxes. However, you will pay the taxes. Okay, then long-term capital gains, taxable capital gains rate. So that's when they sell a business, right? Or not business, a piece of property. The long-term capital gains will be passed through to you, and then they'll give you like the little paperwork that necessary for that. And then return on capital, that's not taxable. So if they're returning capital, what happens is your cost basis is lowered. So an example, if you bought it at $50 and they do a return on capital dividend of $5, you won't pay any taxes on that. However, your cost basis will be reduced to about $45, right? So $50, $5, $45. Even if you didn't buy any more, your cost base is now $45. If you were to sell it, the government will look at your tax basis or your cost basis as $45, not $50, even though you bought it at $50, okay? So depending on the REIT, they'll do any form of return to you, and just something to keep in mind, okay? So one thing that they do talk about here is having REITs in retirement accounts. So if you do, you get the full tax advantage. Basically, you won't owe any taxes for the most part. Again, talk to your tax professional. They can give you a little bit more color on that because your personal situation, depending on your country, state, etc., things can be different, okay? Just this is a broad piece of information. Now, when you understand that the tax implications of this kind of entity do not service the ability for the government to collect taxes on these entities, you can understand why they've outperformed the market over the long periods of time, because taxes are a huge deterrent of gains, right? And not deterrent per se, but they hinder those long-term gains over time. And if the tax man isn't taking a piece of the pie each time, you can compound and compound and compound and compound, right? So when you remove the tax effects, right, that's what these measures show, that they've outperformed over long periods of time, because it's not taking into account taxes, right? Because they're taking into account just the share price rising plus the returns of the dividend, but they're not calculating, okay, this is how much the individuals who owned it paid in taxes. They're just looking at that. And so when you look at just the entity level, of course they're going to outperform because they do not have that tax, right? Regardless of what the tax rates are, as long as the structure of REITs or how the government treats REITs are shown below, all right? But again, it's not that no one's paying a tax, is that the tax is being passed on to you, right? Because corporations are there's double taxation going on there, because the corporations pay the corporate tax rate, and then when you get a dividend, you pay the dividend tax, right? So then it's double tax, and it ends up being or equating to about, where the government sees it as regular income tax, right? And you won't pay taxes on your dividends unless you make a certain amount. Okay, so it all evens out. Everyone has these misconceptions of, oh, corporations pay low taxes. It's like, well, who's the people that own the corporations? Well, they pay a tax, right? So then the taxes are still there. Okay, so that pretty much covers that part. Now, I will go over some accounting specificities, but I want to actually go over some of the industries, right? So different types of REITs, and these are equity REITs. I'm not going over mortgage REITs, but I'll just cover mortgage REITs as one category. Mortgage REITs are ones that own mortgages. So they will invest and sell equity to get mortgages. And then those mortgages could be in the commercial space, the residential space, typically in the commercial space. And they usually can sell it to these equity REITs. So you need to know the difference, just equity REITs and mortgage REITs, right? And there's a hybrid. There's very few hybrids out there. I think Starwood is an example. Starwood Property Trust is a hybrid REIT, but I won't be covering those in so much detail. But just know that mortgage REITs buy mortgages, and then equity REITs buy not businesses. I almost say that all the time. Buildings, right? Because they're both B. So buildings, they'll buy the properties themselves. All right. And then these are the different categories, and you can see their outperformance, right? So this is taking a look at the sectors, their outperformance year to date. And this is not up to date to this year, by the way. But you have data centers, manufactured homes. So this is what I want you to focus on. Don't focus on the returns, just the different sectors: data center, manufactured home, industrial, single family rental, healthcare, apartments, student housing, et cetera, et cetera, et cetera. So I'll show you one example of each in just a second, but I want you to kind of digest that there's so many different types of properties you could possibly invest in. There's pretty much a REIT for everything. One thing that's not even included on here is infrastructure REITs, or very niche REITs such as cell towers. There's also REITs for billboards, stuff like that. So there's REITs literally for everything. There's even REITs for the MJ space. So they own the land that's that product is cultivated on, stuff like that. So really interesting sector, REITs. So I kind of want to go over now, and you know what? I'll show you guys the different ones I've outlaid here for you guys. So remember those categories. This is in by no way, shape, or form a recommendation on any of these. In fact, I haven't done analysis on most of these. These are just some of the ones I came up with to my head and just put them on here. So these are examples. So you have, you guys can pause the video here and just look up all these companies individually. But for the most part, there you go. All right. So each one of those is an example. They don't exactly fit sometimes with the entire category. So like, for example, O&L has a different strategy. There's a video on our channel about O&L specifically and their difference in strategy, but there's also Boston Properties, which is one of the bigger office REITs. MPW is a different strategy versus the other healthcare REITs. So they don't own, healthcare facilities like OHI. OHI is one that focuses on the retirement facilities. MPW is more like medical office buildings and hospitals. So just so you know, within each category, they'll have different strategies, okay? So not to overwhelm you, that's just an example real quick. So let's actually take a look at, I guess, two examples and what some of the problems that might occur. Okay, so first one we'll go over is realty income. This is considered to be the creme de la creme of net lease, okay? And before we go over this, I want to explain what net lease means. So net lease is a type of lease, right, in which the tenant and the owner come into an agreement as to what will be covered. A net lease typically says that any form of combination of the taxes, insurance, or maintenance will fall upon the tenant, right, and any combination. Then there's double net lease, right, which is two of those three. And then triple net is all three, but it doesn't dictate how much. Okay, so each agreement can be different, and so the percentages of how much they'll cover might differ depending on the tenant, depending on the company that they focus. Okay, so but what you need to know is triple net is that the tenant will cover a portion of all three at the very minimum, sometimes 100%. Okay, and depending again on the value of the property, the quality of that property, it could be drastic, right? And you need to also know that there's different categories of properties, right? So there's A, B, C, D, E, not E, F, but D and F, right? Just like your grades when you went to high school or college. So you got to understand that different properties will have different demand, right? A properties are going to be the most coveted. They're going to have the nicest amenities. The surrounding area will be very nice. And that goes for office, commercial space, et cetera. So those are things you want to think about. Then you have a concept of anchor tenants. Okay, so depending on what type of property you're considering, right, you want to focus on, is there an anchor tenant? So think of, your local grocery store. That's typically an anchor tenant, and then there's little stores nearby. So the anchor tenant is going to have the best deal, the lowest rent per square foot, and the other tenants nearby, they're going to be paying up because they want to be close to that anchor tenant, because the anchor tenant drives business for the local area. So if you're investing, for example, in a shopping center, or like something where there's, several anchor tenants. You want to make sure that those anchor tenants are healthy and that they're not going out of business. And the reason why I'm mentioning that is one of the case studies that I'm going to cover is going to be specifically about that, and why, even though super investors were invested in it, it was a terrible mistake. And I don't like it when other content creators or other investors I see out there, they quote super investors or they show super investors are investing in this, and then they go crazy over it. And then they make a mistake, because even super investors make mistakes because sometimes they don't understand the industry that they are or looking at, and they, invest in something that, isn't what it seems, right? But for the most part, something like Realty Income focuses on single tenant properties. Okay. What is a single tenant property? And you know what? I'll take this out so you just focus on this. So single tenant properties is when there's literally one tenant. So think of your CVS, your Walgreens, stuff like that, where there's not the multiple tenants. So you think of your center with, your grocery store and then the other tenants. That's multi-tenant properties. So the benefits of multi-tenant properties is diversification of income. However, single tenant properties is easier to manage, right? One-to-one agreement. So there's benefits and drawbacks, but concentration of revenue. So Realty Income owns a huge portfolio of single tenant triple net lease properties, right? And if you look at, for example, the employee count of something like Realty Income, it's very low. I think it's, very low. So they're a very large enterprise, but very little employee count. And you say, okay, well, how do they do that? Well, that's simply because it's of the nature of the business, right? It's a triple net lease, so not a lot of maintenance is required. So they can just basically just collect those rent checks, and a lot of the expenses are covered by the tenant, right? We're not privy to the exact details of how much of it is covered, but we know that enough of it is so that maintenance of their portfolio is very little. They don't need many employees. They can focus on acquisitions and stuff like that. You want to see varying degrees, right? There's going to be varying degrees depending on the REIT we're looking at. So for example, apartment REITs, you'll see a lot of employees because they're actually managing the apartment buildings, right? Or sometimes they have property managers, but again, for the most part, broad brush here, they're managing the different buildings. So they have more employees, right? And it's not a triple net lease because, if you rent an apartment, right, you're paying certain fees that the landlord is, you're paying the rent, right? And the landlord's paying certain fees, like they're paying the property tax. You're not paying the property tax. You're paying it implicitly in the rent, but you get what I'm saying, right? You're not getting the tax bill and going, oh, I have to pay the tax bill, right? So that's the differences between different REITs, and it all varies, et cetera. So Realty Income is the largest triple net lease REIT that we can discuss about. And this is some of the accounting that we're going to be going over. So basically, when we look at this balance sheet, you're going to notice a couple of things, right? You're going to notice land, buildings, and improvements, total real estate. So real estate's at the top because it's the focal point of what this business does. So we have land right here. All right, so land, this cannot be depreciated, okay? Very important. Depreciation is a non-cash expense. It reflects the amortization, depreciation. Well, I use the same word in the definition. It's basically expensing the building, right? Expensing the building, the land, the improvements, right? You can expense those things, and it allows you to put that as a cost, and you can lower your taxes, right? So is it a cash expense? No, but it is an expense, right? So let's say I build a building, right? And then will that building last for the end of time? No, right? So over time, that building will decay, right? So in accounting, we account for that with depreciation. Let's say I make improvements to the building. Well, I make an improvement. Will that improvement last to the end of time? No. Okay. Now, in theory, the land, no earthquakes, no lava exploding out. The land will last to the end of time as long as Earth's around, right? Or as long as that area is around, right? So you don't depreciate the land. Very important to distinguish that. So you have two separate line items, buildings and improvement, and then total real estate at cost. Then we have accumulated depreciation and amortization. This is referencing the buildings and improvements, right? We add the buildings and improvements and the land, and we get the total value on the books, okay? That does not mean that that is the market value. Very important. That does not mean that that is the market value, right? This is simply the value that they carry on the balance sheet, not the market value. Very important. Because we are depreciating, right? We have this line item, which is accumulated depreciation. That's the total depreciation over time that's been added up together. And we subtract that not from the land, We subtract that from the buildings and improvements, right? That's where that's coming from. It's not coming from the land. You cannot depreciate land. The reason why I'm mentioning this is we're going to see a second case study where we're going to talk in more detail about a very bad business, right? A very bad REIT in comparison to this. This is a very good REIT, okay? It's not saying that it's a buy right now. And I'll discuss a little bit further when we get to interest rates and stuff like that. That's towards the end of the video. So we're going from like micro, and then we're expanding into the macro and the meta, okay? But again, real estate investments held for investments. This should be the grand majority of it, right? And this is including the net value. So the net value. So this is how much is held as investment. So that's after excluding those expenses. And that's this minus this, right? And the expenses are the depreciation, right? Is that the market value? This is a review question. No, it's not, right? If they were to sell this, they're not going to get 17 billion. They might get more because the depreciation is not a real expense, right? The value of the property in the market is probably going up and up and up. And that we can check out with the land, right? The land is showing us that the value of their portfolio and land-wise is going up and up and up. It's not necessarily the gains per se, but they could be acquiring more and more land, which is more likely what it is. But we can reflect that in the gains, which should be in a different line item in a different sheet, right? This is just showing you what they hold it on the balance sheet at the accounting value, we could call it. Let's call it the accounting value, okay? And then later, because they focus on real estate, that's why it's at the top. Oh, and this actually we should talk about this one. So this is the lease intangibles held for sale, okay? So held for sale. This is what they're planning on selling. So we want to hopefully see this as a little bit lower than the value, and it is. They have a churn rate. So sometimes over the course of the years, they're liquidating certain properties so that they can focus on the better ones, and then you're just hoping that they're optimizing the portfolio. All right. So we're going to see this line item, but this is held for sale. So they're separating this from the ones held for investment. You see the difference? Investment and held for sale. They're going to sell these, and the other ones they're going to keep. They're going to keep and hold the rent, right? That's their plan. If eventually they decide some of them are going to be held for sale, they're going to change them over to this, and there's going to be some other accounting stuff going on. But anyway, for the most part, now we see the traditional balance sheet, right? Where we see now the cash, the accounts receivable, and all that. But the primary reason for this business existing is real estate, so it goes to the top, all right? Even though typically on a balance sheet, you go from most liquid asset to least liquid asset. Here it's a little different because they're going to highlight the real estate, okay, first. Okay, so we want to make sure, look at this liabilities and equity. They kind of combine it all and crunch it all into one. Typically, I like to see it separated, but whatever, we can work through it. You want to take a look at the debt. So lease intangible liabilities, whatever about that. I want the loans, where the loans at? Notes payable, there it is. Okay, so that's basically the debt. So REITs, they issue a lot of debt. They can issue through bonds or mortgages. They can do mortgages, but they can do bonds as well. And so they have about 8 billion. So as they acquire more properties, it should be going up. One primary way that REITs acquire more capital is dilution. So you will see dilution with REITs. This is totally normal. Do not panic. Do not say, oh, this is terrible. That is one way that they raise capital. And in fact, the more expensive the REIT trades, the better the deals they can get, because they can acquire capital for cheaper. And then the cap rates, I'll go over what cap rates are in a second. The cap rates difference between them and their dividend will actually be accretive to the shareholders remaining. Okay, so I'll explain what cap rates are right now. So cap rate is very simple calculation. All you do is you take the rent, right, and divide by the property value, right, or the acquisition price. So if we buy a property for $1 million and it generates $50,000 a year in rent, and net rent, NOI, so net operating income, then the cap rate, and by the way, let me pause there. Net operating income is basically the income after all the expenses for that property. So and it's only that property. It's not like the administrative expenses, just that property. The NOI divided by the acquisition price is our cap rate. So if our cap rate, for argument's sake, is 6%, and the dividend yield on our stock is 3%, right? We take the difference, 6 and 3, and we get an accretion value of 3. Because if we sell all the stock, right, we just issue a bunch of stock and we buy that property with the money we made from that stock sell, then we would increase, right, the cash flows, the difference would come to the rest of the remaining shareholders. So even though we were diluted, we're getting more cash per share because the property is generating a higher cap rate than the dividend yield. Okay, so a little bit of a detail there. All right. So for the most part, realty income is actually really nice. I think they give you a ton of data. So you can see here, they give you going way back since I think, yeah, the IPO. They don't have to do this, but they want to do this, the historical performance. And we can see the revenues, et cetera. And I think they should show, yeah, common shares outstanding. You can see here, they're growing tremendously, right? But if we see the dividend, also increasing, and they should have a per share, let's see, dividends paid, adjusted AFFO, funds for FFO. Well, here's the annualized dividend amount per share. You see per share, it's been growing, right? So for the most part, that's evidence of the accretion, right? Oh, and actually here's the first share. This is all per share. Guys, I'm sorry, I'm blind. Per share common data. So per common share data, sorry. And funds from operations. So this is important. This is the cash per share. This is what you need to pay attention to. This is showing you accretion. So even though they're diluting you, right? Common share is going up and up and up and up. The FFO per share is going up and up and up and up and up. So they're not diluting you on a per share basis. They're actually accretive to you on a per share basis. Very good. All right. So that's what you want to look at for REITs. Okay. So we're looking at a good one. Let's take a look at a bad one, right? And this is one that has been commented on by value investors. And value investors are saying that this was a crazy investment. I mean, hindsight's 2020, but I did mention this before the drawdown. There was a video on this channel called, I think, David and Goliath. It was comparing these two companies, and I'm just bringing them back. And I'm showcasing you in a more detailed accounting way to kind of explain to you the level of quality difference between these two businesses and why the other one was just not a good investment, even though super investors were investing in it and the value investors on YouTube were investing in it. Why it was such an obvious not buy, and I stated that in that video. But I guess, for some people, they just wanted to ignore that and then just simply say, oh, super investors, copy super investor, duh, that's my DD. No, don't do that. Please don't do that. Right? You'll hurt yourself. So Seritage growth properties. All right. So let's actually look at the price action between them. So we have O stock, and O stock's been pretty stable. And again, I'll when we get to the macro, I'll discuss the meta of what's going on right now. I used to own O stock. And then we have SRG, which is Seritage Growth Properties. All right. So the video was posted like around here. It was last year. And for the most part, it was much higher than what it is today. Here we're seeing the drawdown, right? And I think it actually went up and then came back down. Now it's done quite terribly. So it's down, yeah, 37%. Disgusting. All right. So why, right? This is the spinoff of Sears, right? So context to get some historical information, spinoff from Sears. This was the real estate that Sears held. Remember, we just said, or what I just said, a little bit of a quiz. What is very important for some of these properties? The anchor tenant, right? The anchor tenant. So with the anchor tenant, we want to pay attention to the quality of that anchor tenant. If the anchor tenant goes away, that lowers the value of the property, the land, et cetera. So let's take a look at the books on hand, and we see Seritage Growth Properties. Let's take a look at the value of their real estate, right? So let's take a look at the land. Land's been declining, right? They're either selling it off, stuff like that. The accumulated depreciation, they're depreciating some of their buildings, et cetera. The buildings and improvements, this is the value of it on the books. Everything's coming down, right? They're selling it. They're trying to do stuff with it. Whatever. Their construction in progress, that's basically them trying to improve their buildings so that they can actually get them to have some sort of use. But again, this is Sears land we're talking about. This is locations that were, with like varying degrees of quality, right? So we're going from something that's fantastic to something that's kind of mad. This is the trash, right? That kind of is like, oh, do you want to pick it up? It's there. It's free. It's trading below book value, I guess. I think it is. Don't quote me on that. But I think it's trading below book value. You know what? We'll check live. You know what? After this, we'll go check what the book value is based on like a website. We'll go on a website and see what their book value is. All right. So rental income. You see it's declining. This is bad. This is not good. This is not a good business, right? There's clear, obvious red flags saying to you, hey, this is a terrible, terrible business. And if I look, okay, so let's just Google this. And this is kind of what the thesis was. Super investors invested in Seritage growth properties. And this was very common talk. And, so let's see. I don't know what this is. Okay, so Monish Pabrai. All right, so Monish Pabrai is invested, Guy Spear, and Third Avenue Management. All right, so Monish Pabrai, interesting, is how percent of portfolio, he owns 40% of this business. Oh, I hope that that's more recent and not just now. Recent activity. Ooh, so I wonder how Monish Pabrai is doing. But anyway, I disagree with Monish Pabrai on quite a bit, but that's fine. He's done very well in his career, and I'm just some snot-nosed brat who's just, getting started in my career. So, I'm not going to sit here and say he's terrible at all, because he's not. He's actually very intelligent, but we just, we have our disagreements, right? I would love to have a sit down with him, by the way, one day. Anyway. So me and him disagree, for example, on the VIE structures and the implications of that, et cetera. But Monish Pabrai often discusses talking about copycats, like he copies some investors. That's 36.79% of this portfolio. I'm going to have to really take a look at Seritage and see what the heck he sees. But for the most part, bird's eye view, when I did the video, this is a terrible business. It was telling me red flags all over the place. The model was spitting on this thing, telling me I should stay the heck away. Hindsight, it was a good decision. Maybe now the price is different, but I don't really see it. It's a lot of speculation that if they can do a turnaround, it's going to be good. But anyway, this is kind of an example of, I guess I have to close. Yeah, I don't want. All right. So Eddie Lampert. Okay. Monish Pabrai, 180 buy. He added 0%. Share change 31. Really? All right. Okay. No, that doesn't count. All right. In 2020. Oh, yeah. No, he's down a lot in this position. Yeah, he's down a lot. Okay, so that's that. I'm not really gonna kick that while it's down. So yeah, Seritage growth properties, not a good business for the most part. Oh yeah, right here. So gain on sale of real estate. So they are selling their real estate. That's what they're doing. They're cutting down on everything. And then the gain on sale of real estate, it can be misleading, because remember, depreciation plays into effect. So you may have bought it for something, and if the depreciation over time is drastic, it reduces the cost basis of the property. And then when you sell it, if it's higher than the depreciated amount, that is a gain on the sale. It doesn't mean that it actually rose in value. Very misleading, but something to kind of think about. In accounting, that's what we're basically saying. It's low. They sold it for more than the book value of the real estate, but the book value is declining over time due to depreciation. Okay. So let's take a look just through this interest expense. So they're paying about that. So they have obviously debt. Okay. So impairment of real estate. So yes, that is the declining in value. That's not good. Okay. So that's going on their income statement, and it's lowering their EPS because the value of their real estate is coming down. So that's, again, it's not good. Real estate, you have to be very careful. Real estate is simply not saying this is the book value right now, because the book value can change. Property values aren't fixed, right? So you paid whatever for it, but does the market value it the same, right? Is there a use case? What kind of properties do you have? All these things count. How's the economy in the area that you own real estate? Very important, right? So I would rather, for example, be buying real estate in Florida, Texas, rather than having legacy properties in California or New York. Now, however, that caveat aside, California has really good tax laws regarding real estate. For example, that they passed in the 70s. Back in California's glory days of when they were growing like crazy, they passed something where basically the tax on the property is fixed to what you paid for. Well, Texas has a problem because since the value of the properties are growing so fast, the tax liability on those properties is growing with it, right? So then you don't have that permanent state of stagnation on the property tax, which allows you to create a more predictable model for valuation. So I like that about California. If you can buy real estate somehow at a really good price, you have a fixed property tax and you just never sell it, right? Unless they change the Constitution of California, then something changes, all right? But yeah, for the most part, I won't really talk too much more about Seritage growth properties, just simply that I showed you a really good one. And you know what? I said we get the book value. Let's go to a free website and let's actually just see. I wouldn't really trust the book value all that much. And let's take a look at what the book value is. So I wouldn't really trust this website. This website just like throws together some stuff. But okay, I just wanted to see. This is what sometimes a retail investor will go and just see this and say, oh, book value is 13.74. It's below book value. I'm picking up $1 for 50 cents. No, don't do that. Okay. Don't do that. Because it's a little more complicated than that. Investing's not, that simple. Okay. And then I'm not saying that, Monish Prabhai did this. I hope he definitely did not do that. He 100% did not do that. I wouldn't believe if someone told me that was his thesis, I wouldn't believe him. All right. He probably 100% put a lot more work into that analysis. We just disagree on that analysis, right? But he could be seeing something I'm not, and I'm not going to say I'm right or he's right. Let's say he's right. Okay. And I'm just saying for the meantime, if he's right, I can go back and check and get a better price now. All right. So distribution. Yeah. All this is kind of less like the cash flows. Did I show everyone? Yep. I have to show you guys how to calculate AFFO because this is very important. And then we can have a little bit of a discussion on AFFO. So this is how you calculate FFO, right? AFFO is a little bit more conservative at times, but FFO is the baseline. So FFO is net income plus depreciation because that's a non-cash expense, plus amortization, another non-cash expense, plus the losses on property sales, right? Because that's not an operation, right? That's just the sale of a property. So that's not operations, minus gains because that's not an operation, right? Gains on the sale of property, minus obviously the interest income because that's part of the operations of this business, right? So that's basically what we use as the owner's earnings equivalent, FFO. And when you evaluate the valuation of a REIT, you should use FFO or AFFO, all right? So for the most part, that's just the cash flow. So I'll stop there with that. And then now we're going to go into the meta level. Okay. So if you stuck with me this far, we've just covered the micro stuff, business level stuff, some of the accounting details. Now we're going to discuss a little bit about what the macro backdrop is for REITs. Okay. So for the most part, there is a heavy correlation between interest rates and REIT performance. So I'll show you this. However, there are moments in time when that's not the case, right? So traditional theory or traditional understanding says that when rates rise, that's bad for REITs, right? Well, it depends. All right. It's not so easy to just do a broad brushstroke. I wish things were that easy. Then we just say, oh, when this happens, this will happen, right? No, it depends. So take a look here. So December 1976 to September 1981, we saw rates rise. Rates beginning yield was 6.9%, ended at 15.3% with a change of a positive 8.5%. I'll say the word positive because I know they don't give out the negative signs, but it's obvious when it's a decrease, right? You just look for increase or decrease. And then the REITs outperformed. We had 137% REITs as a sector outperform, and stocks only perform 46%. Difference 91.4%. Okay, the context is missing here, right? Because we need historical context. Well, for those of you who are looking at the years, you might be saying, oh, that's the inflation period. Yes, that's the inflation period. So during the inflation period, what happened to the real estate? What did the value do? Went up. So if the value of the underlying real estate goes up, the value of the portfolio goes up, the book value goes up, the price has to go up. There's no such thing as free money, right? So if the REITs were to, in theory, sell everything, you would make more in the dollar nominal amount than what they paid for back in the olden days, right? So it had to be reflected in the share price. So during periods of large inflation, the REITs outperformed stock because they owned real assets, right? And even though rates went up and the cap rates went up, and all that, the inflation was going up faster. So the underlying real estate was going up faster. Now, from that point, then we started to see a little bit of a drawdown or less performance from 1983 to 1984. This is the period where rates started to tick up a little bit. And then we'll see rates tick up a lot, in the 80s. So then we see here, the rates were going up from 10.5 to 13.6. Sorry. And then we see they perform 35.6%. Fantastic. Now we get to that period where rates went up from 1986 to 1987, but we didn't have that inflation backdrop. So now we see the underperformance, right? Because now the value, the underlying of the real assets aren't going up nearly as fast, right? And so we see that the underperformance of negative 10.1%, while stocks went up 10.9%. Okay, very interesting to note. Even though there was an increase of rates of 2.4, that 2.4 is way smaller than over here at 8.5. right? But the contextual background that you need to understand gives you a little bit more color, right? It's more than just the rates. There's more than just that, right? A little bit of added nuance. And that's something on this channel I hope is like the thing I just drill into everyone's head. Nuance is super important when you're talking about businesses, right? So it depends on the time period, depends on what's going on in the macro level, depends on what's going on, what happened, the past 5 years, because things can build up and then something's about to happen, right? So it just depends. Everything just depends on what's happening, right? Depends on the REIT too, because some REITs are going to outperform and do good in bad times, right? Just like companies. Some companies are going to do great, other companies are going to do terrible. Maybe the overall economy does bad, but there's going to be 1 or 2 companies that does really well, at the very minimum. So June 2003 to June 2006, we see rates, they rose and they outperformed. Wait, what was going on? All right. So this was, what was going on. 2003 to 2006. That was what was going on. The value of the properties were skyrocketing. We were in a bubble, and obviously REITs outperformed because you see the underlying assets were going up. Right. That's very important. Are the underlying assets going up in value? It doesn't matter if rates, right? Then the rates come second. But if the values are remaining kind of the same, right? And there's no macro backdrop that's causing the value of the properties to rise drastically, then rates are going to come in and smash that down, because then the rates are going to overpower whatever forces are happening, right? Because here's what rates do. When rates go up, they lower the cap rate, right? Or sorry, they increase the cap rate. Rates go up, they increase the cap rate, right? So what is the cap rate again? NOI divided by the property value, right? Well, if rates go up, that increases the cost to borrow. So let's say your cost to borrow is 5%, right? And then now rates go up and your cost to borrow is 7%. Well, when rates were 5%, you could get the property yielding 6%. You could do that because it would be accretive. But now your cost to borrow is 7%. So that 6% property, if you were to buy it using your cost of borrowing, you would actually be dilutive, right? It would not be good. You'd be losing 1%, right? Not worth it. So in other words, all the market will demand higher cap rates because you need to pay less for the property in order for it to make sense, because rental markets are separate. I want everyone to separate rental markets. That's another thing that comes into play. But let's say rents remain the same. You can't pay that much for that property because your cost to borrow is increasing. Right now, if rents were to go up for other reasons, during an inflationary period, that's different, right? So, but separating that, we have the cost to borrow, and that is why REITs can suffer during that, because especially that when the rates go up, their stock prices could also come down just on that, because they're competing with the risk-free rate or whatever. And on top of that, when the book value may or may not come down because of rising rates, that happens. But it matters what other forces are at play. So there's a lot of forces fighting each other. And then you got to think about all of them at the same time, right? And basically now, how does that pertain to now? Well, for those of you who have seen some of the older videos for earlier this month, I have sold out of all REITs except for one, Vici Properties. Oh, Vici is not even included in the examples of equity. But that's another one, casinos. Casinos is like their own separate category almost. But for the most part, I would say that I only hold like a watch position, but I'm interested in that REIT. And I obviously O is like the creme de la creme of net lease, and also ONL, which is the office play, that they have a different strategy that I do like. But under the macro backdrop, I sold out of the REITs, took the profits on O. And by the way, REITs I hold in retirement accounts, only retirement accounts. I don't own any REITs outside of retirement accounts. That's kind of my rule of thumb. I'm not saying that's good for you or whatever your situation is. That's my strategy. So I'm not paying any capital gains on those gains. Okay. But for the most part, those REITs that we're discussing, I sold them because of the macro backdrop that we're entering. And what is that macro backdrop? Well, rates are rising, or the fear that rates will rise will cause, in my opinion, for prices to come down. Now, for those of you who remember Austin's favorite stock was ADC. And I discussed with him that ADC, I like the business, by the way. I do like it. It's a good business. It's actually founder led and run, but by the same family. And actually the company is named after the last name of that family, but it's called Agree Realty. So Agree Realty, I like the business. However, I believed at the time that given the macro backdrop, the price would come down. and it has come down. For the most part, REITs have come down. And what I'm kind of saying with that is it kind of makes sense. Basically, even if rates don't rise, the fear that rates will rise will be good enough for things to come down in the short term. Now, remember all the other stuff in the macro backdrop that I'm kind of pointing out right here to you guys. There's so many other factors how it can affect the longer term performance of REITs, and you got to pay attention to all of them simultaneously to kind of, decide. Or you just say, to hell with all that. I'm dollar cost average in. I don't even care. Okay. That's probably the most successful strategy of all of them. Okay. For your probability of success. So that's, again, do not do what I do. What I'm saying is if you like a REIT, you really like a REIT, and you like its performance over the long period of time, you think it's going to continue to perform over long periods of time, do not worry too much about the macro backdrop. Just average in. For example, the VNQ, Vanguard Real Estate Index, that's outperformed the broader index for a long time. Will that continue? That's a good question. Well, it depends on all those forces I've been discussing. What's happening? What's happening to rates? What's happening to inflation? What's happening to all this? What's happening to the rental income? What's happening to the economy of the United States? Because, here's going back to the rental side, right? So if rents aren't rising, rents can only rise if the economic backdrop is good, right? Because then you can charge more rents to your tenants because they are making more money. But if they're not making more money, you can't charge more rents. And if they don't charge more rents, then you have all these other forces that are also maybe also fighting you on this side, for example, and that could be lowering your property values. So for example, let's say there's high inflation, right? There's high inflation, but for example, there's no one to buy your properties, right? And I'll give the example of my home country, Venezuela. Okay. There was hyperinflation. What do you think the value of the properties are? They're worthless, right? In real terms, they're worthless. In nominal terms, they skyrocketed, right? In Venezuelan Bolivar, it's skyrocketed. But let's think about the other forces at play. Rents, did they go up? Yeah, they went up, right? But could they go up that fast? Because what we saw was a destruction of actual value. While the rents were going up, the value of the currency was skyrocketing faster, declining faster than the wages were going, right? And the rents were going. And then in nominal terms, while the real estate value was going up, the inflation was greater than the actual value of the property going up because there's no one to buy. Because at the end of the day, it's also dictated. Can you even sell it to someone, right? What can they even pay for it, right? Because the economic backdrop of the nation was collapsing. So in that instance, the real value of the real estate didn't survive the impending economic doom, right? So that's to kind of color more why there's so many different factors at play with real estate values, that it's not simply, rates are what matters. Economic backdrop are what matters. Rents are what matters. It's all these things simultaneously. Now, for example, rents are really good. If you looked at rent or cap rates during the 2006 bubble, real estate bubble, they were actually really low because rents didn't rise as fast as the property value. So they were a good indicator that we were in a bubble. So you want to actually take a measure of what those cap rates are. And I'll give you my personal use of cap rates, but you guys can adjust this. This is not like a definitive law in REITs, but for the most part, I look at, for example, big cities. I think the cap rate should be between 2 to 5%, 2 to 5% around there. And it depends on the city. And then if it's a declining city, I would want higher than 5%. That's what I desire. Okay. And what I would look for. And then if it's in the suburbs, then we're increasing to like 6, 7. And then if it's, like commercial properties, it starts to rise 6, 7. And then industrial properties, 8%, 6%, depending on where it's located, because then location really matters. But we're talking about, geography for the most part, not real estate property type. So you see property type, location, both of those are also factors, right? Because different property types are more valuable than others. And then location, along with property type, gives you a different valuation. So those are things to think about. And then if you go into the rural areas, that's when I'm expecting 10, 11, 12%. And I think the rural market is interesting. Depends on where you're buying, what state. So yeah, that's kind of like how real estate more or less works. Location, then property type, right? So different demands for if it's residential, multifamily, industrial, single tenant, use case. So those are some things to think about. And again, the economic backdrop, all those factors are at play. So just think about that. All right, guys. So this is basically the first sector-wide view. I hope I provided enough value. If you have any questions about specific topics that we discussed, go ahead and leave it in the comments below. I know that the macro backdrop is probably really complicated because there's so many different factors. I hope I highlighted that to you guys, that it's not just one factor. You can't just pinpoint it and say, okay, I'm going to strategize around that one single factor, because then you could mess up. It's more difficult than it looks, and that you're probably better off. Most people are going to be probably better off dollar cost averaging anyways. And then just picking different companies that they like, or an index that they like, and then just dollar cost averaging into the index. That's why Jack Bogle was all about that, because, you know, there are so many factors to take into account. And just because I did something doesn't mean you should do it, because it could be entirely a mistake, but I did so because I felt it was good for me. Okay. And again, think about my tax situation. I'm not going to pay any taxes on those gains. In fact, it's going to compound into other things. But for the most part, that's something to think about. And if you guys have any other sector-wide requests, go ahead and leave that down in the comments below. One more thing. So there was a video that is just now out. It came out because there was a copyright strike on it. It has a meme that it was supposed to come out Monday, on the week of the release of this video. So it's supposed to come out, I think, on the 22nd of January. And the context, you know, is lost because the video came out later, but, you know, the whole YouTube shenanigans. So for going forward, if I create a custom meme, it's going to be on the Instagram. It's going to be posted also on Instagram, because Instagram won't restrict me. And then I'll always try to post it on YouTube, but it will always come out later on YouTube, and it might miss the context of the time that it's shown. So that's just something to think about. All right, guys. On that note, I really enjoyed making this video. Again, questions down below. I'll try to respond in a timely manner, but thank you guys so much. Have a good one. Bye.